Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Alix Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at how Donald Trump's empire has landed billions of dollars since his last presidential campaign kicked off.
Plus, we'll discuss how sales of the department store chain Macy's are being impacted by tariffs.
But first, we begin with big tech and the world's most valuable chip maker, Nvidia.
This week, the company gave an upbeat revenue forecast for the current quarter, even as a slowdown in China weighed on first quarter results.
For more on why, we were joined by Kunjan Sobhani, Bloomberg Intelligence Senior Semiconductor Analyst.
We first asked Kunjan for his take on Nvidia's most recent quarter.
Yeah, two big takeaways. The GB200 RAM continues to be stronger than we expected or people anticipated. We believe, based on our math, the GB200 came in $3 billion above expectations, both in 1Q and fiscal 2Q, which is what helped them beat the numbers despite the significant China headwind, which was $8 billion for 2Q. The second key point was, if you take out the China write-down, gross margin actually came in better than anticipated, again, suggesting that GB200 yields and cost optimization are running better than anticipated. And we now expect margins to continue to rise through the year, exiting year at mid 70%, which we believe was the very key, a lot of key important factor for the long-term investors in the company.
Yeah, that's what you were mentioning yesterday, that making sure that that Nvidia can deliver the mid 70s for margins at the end of the year. So what are your outstanding concerns / questions when it comes to Nvidia?
Well, the number one is we really hope to hear the new China variant and get clarity on it, which didn't happen. There have been some rumors flying around that might soon happen, both from Nvidia and AMD. But as we would like to get it officially, the specs, what kind of ASPs and what sort of applications it will be targeting to, as soon as possible, to put those concerns at bed. The other key thing which right now they did help reduce the risk, which is slow down from the hyperscalers and cloud. We don't see that risk, but as we get into fiscal 4Q with the August timeframe, this is when hyperscalers and clouds really think about their CapEx budgets for next year. That will be another key milestone for them.
The revenue it gets from China, I don't know, up 15%, 20%, I'm not sure what it is. I know it's been declining. Could that go to zero? And if so, can the stock still work if that were to go to zero?
So at this point, the revenue from China within data center is almost zero, right? And estimates don't include anything back from that for at least for this year. So that's almost gone to zero. There is definitely China revenues coming from their gaming segment and their auto segment, but the data center, which is the real meat of it, which they were expected to sell about 15 billion of it just this year from the H20, which has almost gone to zero. So until the new compliant chip does not come out and they start selling, it's essentially down to zero right now.
We were talking about how important Middle Eastern clients were to Nvidia, for example, and the kind of CapEx that they're spending. What other growth areas or regions do you think are going to really start delivering?
Yeah, so a couple of key regions we are keeping an eye on. Just like you mentioned, Middle East, there are a lot of sovereign entities. So just don't think of Middle East, think of like India, Japan, and a lot of other countries, because right now having self-regional AI models, having regional AI localized data centers is national priority for a lot of emerging and big countries. So all of these regions have already announced planned and big budgets based on their respective GDPs to spend on. So Nvidia will be a big beneficiary of that. The Middle East is just a key example. Like I said, you have other regions, especially India and Japan, investing heavily here as well. The second key driver outside of the top 4 CSPs are going to be the enterprises now. One big example is XAI. They have announced significant big projects. The other second example is the Stargate project. So we anticipate a lot more such projects at the enterprise level coming in, where they will start to pitch in to robust billions of dollars of growth for Nvidia.
Kunjan, what's the competitive landscape these days? Nvidia versus who?
Yes, the answer to that is yes.
Nobody. But just for theoretical purposes, the second biggest competitor in the GPU landscape is AMD. But the bigger threat to us is the ASIC providers like the Broadcoms and Marvell, because in terms, when you look at the TAM sizing, right now the AMD's market is what the revenue they're generating is still significantly small, versus the ASIC market is expected to grow faster. And that they are not a direct competitor, that you don't replace out an Nvidia GPU. That they are not a merchant GPU, but they still take away the wallet share at the same large customers. So they could start deploying their own ASICs and not rely as much on the Nvidia GPUs. That's a long-term risk.
Our thanks to Kunjan Sobhani, Bloomberg Intelligence Senior Semiconductor Analyst.
Each week, we take a look at research from Bloomberg NEF, previously known as New Energy Finance.
They're the team at Bloomberg that tracks and analyzes the energy transition from commodities to power, transport, industries, buildings, and agricultural sectors.
This week, we looked at the final version of the tax and spending bill passed by House Republicans and how it represents a nightmare scenario for clean energy advocates and defenders of the Inflation Reduction Act.
For more, we were joined by Derrick Flakoll, BNEF lead U.S. policy analyst.
We first asked Derrick just how bad this tax bill from the House is for clean energy.
Well, it's pretty bad, to be honest. Depending on which market you're looking at, you might see more or less severe restrictions. If you look at home batteries, home electricity credits, home solar, that gets repealed outright at the end of 2025. And if you look at utility scale stuff, there was already some pretty severe restrictions in an earlier version of this bill introduced by the Ways and Means Committee, nearly unworkable restrictions on any kind of Chinese-linked intellectual property or supplies, as well as earlier phase-outs and a variety of other complicated barriers to usage. Now, this final version of the bill that the House has put out has made that even more restrictive, in part by saying that only projects that begin construction within 60 days after the bill's final signature by the president would be able to qualify at all. So that would really restrict it to a handful of things already in the pipeline.
What it did seem to do, though, is give a lot of leeway, well, maybe a lot's too strong a word, but leeway to commercial solar, for example, but not residential solar. How does that make sense?
Well, the amount of leeway is a little bit relative, and I would say, firstly, the political logic is essentially around sort of the culture war element. The idea is if you're putting solar panels on your roof and deducting that from your taxes, you're probably higher income, you're an elite, so to speak. And so there's probably a desire to reduce that element. In terms of the sort of regional power installations, that's really good for Republican districts. A lot of them have relatively cheap land. It's a pretty big source of tax revenue and potentially construction jobs. So there's an attempt to keep those at least nominally alive. But in practice, the restrictions, the regulations on these credits make them unusable for all but a few projects. This is an attempt to balance between about 12 to 20 Republicans who really wanted to keep those credits alive and practical to use, and a faction that really wanted to cut spending by any means necessary and saw the IRA credits as a great place to go for that. So in practice, it looks a little bit less restrictive, but the sheer web of complications and limitations means that a very, very small number of utility scale projects would actually get that.
Derrick, Tom Keene is famous for saying that companies adapt. Corporations adapt, industries adapt, people adapt. Can the clean energy industry, again, broadly defined, can it adapt and deal and grow and then make the investments in this environment?
I think that's going to be a very big challenge. Certainly, there have been opportunities to try and find alternatives to Chinese intellectual property and suppliers from Korea and Japan. There's progress on building factories out in the U.S., but the level of uncertainty surrounding this bill is pretty high. Even if it gets finalized in something like its current form, you might need to wait for up to 2 years to see final regulations on some of these foreign entity restrictions, and that's pretty chilling to investment. Ultimately, we do see our sort of model for if the credits were fully repealed beginning at the end of 2025, still found that about 83% of renewable projects at the utility scale would still get built, at least across solar, wind, and storage. But that was a pre-tariff projection. We still are sort of thinking how those will fit together since the tariff rates are ever changing. But fundamentally, I think there will be a lot of challenges adapting to this. There's certainly markets where there's still regulatory pushes for renewables. There's still the fastest thing to install or the cheapest. But ultimately, the level of adaptation is going to be fairly challenging and fairly limited given some of the severity of these subsidy-based restrictions.
Which is just so striking, too, because this affects sort of the supply part and the demand part. Like, it hits on both angles. I was talking to the former CEO of Sonova, which had its own problems, including not being able to pay debt, looking at bankruptcy, et cetera, before any of this happened. And I asked him, I was like, can these solar companies stay in business or are they going to go bankrupt? And he's like, bankrupt. Like, there's no way that they can survive. Is that what we're going to be looking for?
I think we're going to be looking at a few different things. First of all, a lot of sort of Chinese assets or joint investments, like there's one with Invenergy and LONGi Solar in Ohio. You might see changes in ownership there, so maybe a bit of a consolidation. Obviously, there's a reason that First Solar stock went up. It's fairly insulated from some of these restrictions, but at the same time, like you're going to see in a wave of consolidation, that does mean you see some losers and some people falling out of the market, and particularly segments that are tied to more price-sensitive sectors, wind, residential solar. You might see a bigger hit to those areas as well.
Derrick, I know you were at the BNEF summit in Munich. What's the view from Europe as to what's happening to the, the green energy initiative in the U.S.?
Everybody was a little bit curious about where that's going to stand, what's going to be permanent. Europe is often thinking, is this maybe our moment to have more investment here because we have a bit more consistent policy through the carbon price, but it's also dealing with its own challenges. There's been a big focus on shifting to defense and energy security rather than the energy transition per se. Sometimes those go together, say by creating local battery storage, reducing reliance on Russian gas. At the same time, you see a lot of both political and economic pressure to continue using gas through a mix perhaps of U.S. liquefied natural gas as well as imported gas from elsewhere. As for investments in the U.S. that a lot of manufacturers have made when the economic incentives of the IRA seem much more stable, they're certainly questioning what will remain. At the end of the day, as I said, you're going to see shifts in ownership, you're going to see consolidation, and depending on the fiscal picture in Europe and the degree that you can fit the energy transition into that energy security framework, you could see a bit of a shift over there.
Our thanks to Derrick Flakoll, BNEF lead U.S. policy analyst.
Coming up, we're going to break down how Meta CEO Mark Zuckerberg is trying to win over President Donald Trump, but may not have a lot to show for those efforts.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We recently focused on a Bloomberg Big Take story titled The Trump Family's Money-Making Machine. You can find it on Bloomberg.com and the terminal.
The story looks at all the ways Donald Trump and his family have enriched themselves since his most recent presidential campaign began.
For more, we were joined by Max Abelson, Bloomberg News finance reporter, and Annie Massa, Bloomberg wealth reporter.
We first asked Max about what Trump's money-making machine is.
If we were able to put it into one word or one line, we really would have. Unfortunately, it does take like 4,000 words to describe because the machine is really, really big. I think what we ended up deciding is that no modern American president has ever positioned his family to make this much money while in the White House. And you can't oversimplify it, either as a supporter or as a critic. You can't say, oh, what he's doing is crypto, or oh, what he's doing is licensing his name, or oh, what he's doing is going overseas, or what the family is doing is making corporate connections. That it really is, we ended up thinking about this as basically an atlas to what the Trump family is doing. To take it seriously and to really focus on the facts and on the numbers and on the places, it was real work, and it was actually, dare I say, even fun to work with Annie on trying to figure it out.
There you go.
There you go. So Annie, I mean, is this? I guess part of the question is, depending on how you look at it, is this legal? Is it ethical? What are the folks in Washington saying?
Well, so one of the challenges of working on this story was that almost week by week, there would be new details to add. And I think what Max and I found was that to go through each of these different categories. We covered real estate, we covered crypto, we covered this kind of grab bag of other ventures that the Trump family has become involved in. You have to go really deep into each one, and there's a high velocity of new deals coming. Now, from the ethical standpoint, what the Trump family has decided to do is they've issued an ethics plan for Trump's second term, as they did in his first term. The way that they've handled it is by putting President Trump's assets in a trust, which is overseen by his son, Donald Trump Jr. But there are some differences in the ethics plan of Trump's first term and his second term. This time around, as we note in the story, the ban on new foreign deals that existed last time is no longer in place, and you can see the new deals popping up all the time.
I found it very liberating, actually, to in our work, rather than putting ourselves in a position where we wanted to say Trump is the most amazing president and everything he does is amazing, or being in a position where we have to say Trump is the worst president and everything he does is illegal. What we tried to do is just to understand piece by piece the way the family is making money. And it was helpful to just use Trump's own words and own plan. Last time around, in the first administration, he was unwilling for the family to do new deals around the world. This time, the family is embracing deals around the world. And by their own account, what they're not allowing is deals with foreign governments. And when Andy and I look closely, what we found is that there are some deals, especially in Oman, especially in Qatar, that really test the edge of that agreement. They are with arms of governments. Now, it may not necessarily be the Trump organization doing these deals. Sometimes there are entities kind of in between. There's this one developer called DAR Global. So what we're hoping listeners out there will do is read our story, because we really tried to very carefully, without doing anything but the facts, just really tried to understand everything about this money-making machine.
So how much of this money-making machine are real deals based on like properties and hotels, and how much of it are like NFTs and capitalizing more on the celebrity that is President Trump? Everyone
kind of knows that Trump real estate empire has in many ways moved for a long time, been moving toward licensing the Trump brand for hotels and developments. That's a big part of what they do now. But what's new in the second term is you see his sons, Eric Trump and Donald Trump Jr., joining the boards of companies, both private and public, and lending the name in a way to those companies. And what tends to happen when they join, either in an executive role or as advisors, is, at least in the case of public companies, sometimes the share prices of those companies will go flying. So it shows the celebrity, to your point, and name that they bring into the business world, into all these different ventures, including in crypto, but in other realms too, like prediction markets.
And to be fair, what Donald Trump Jr. will say, and what he said to us, is, I'm a private citizen. I've been a businessman all my life. It's ridiculous to expect me to stop doing what I do just because my dad is president. And then what Donald Trump will say, a White House spokesperson said to us, is I'm transparent, and I handed over this multi-billion-dollar empire to serve our country. The White House described President Trump as making a great sacrifice. I think it's really helpful, though, to just look at the numbers. And I just want to quickly mention what we found is that the Trump name is powering more than $10 billion of real estate projects since the re-election campaign began. A multi-billion-dollar valuation for this social media company, a money-losing social media company that just went public. Yep. I mean, you forget it went public last year, plus the money from crypto, plus the money from corporate connections. I think it's worth taking the time to kind of wrap your arms around it, because it really is sort of, I guess, unlike anything I've ever reported on.
All right, thanks to Max Abelson, Bloomberg News finance reporter, and Andy Massa, Bloomberg wealth reporter. This week, we looked at another Bloomberg Big Take story titled Zuckerberg's bet on Maga has yet to bear fruit. You can find it on Bloomberg.com and the terminal.
The story looks at how Meta CEO Mark Zuckerberg has done everything he can do to win over President Donald Trump, but it's not yet clear he has much to show for it.
For more, we were joined by one of the story's co-authors, Kurt Wagner, Bloomberg News tech reporter. And we first asked Kurt what Mark Zuckerberg's strategy has been to get on President Trump's good side.
We noticed this starting in January. Actually, slightly before the inauguration in January, Mark Zuckerberg showed up at Mar-a-Lago for a dinner with Trump, which was, something that was notable, not just because of who Mark Zuckerberg is, but because of the contentious relationship that they have had for years, ever since Facebook and Instagram banned Donald Trump after the January 6th riots at the Capitol. And so he goes to Mar-a-Lago. He shows up at the inauguration. He starts making frequent trips to the White House to meet with Trump and other officials in the administration. And so we just sort of set out to figure out what is this strategy here, right? On the one hand, it seems somewhat obvious. Everyone, wants to be close to that center of power in DC and build those relationships. But given the history between these two men, it was very notable. Like, is this a shift in Mark Zuckerberg's personal politics, or is this just him simply trying to play this political game? And I think through the reporting and interviews that we did, I think what we sort of came to see was this picture of a CEO who's less tied to his own specific, political ideals and more a sense of self-preservation, right? He's someone who out to try and make sure that he and his company survive, and that's what this is all about.
Which was so striking in your piece, because what came up for me is that no one seems to like Mark Zuckerberg. Whether you're a Democrat or Republican, everyone seems to ignore him and not like him. So to your point, it's really about the political showmanship.
I think he's an easy person for people to point to, right? We've seen this for years in Congress. Like, when things go poorly, it's easy to point to Facebook. It's easy to point to Mark Zuckerberg. What happens in the world, what happens in society usually happens on their products, on their platform. So they end up sort of, in some ways, they totally deserve a lot of this blame. In some ways they don't, but they get it anyway. And I think Mark Zuckerberg, has been a uniting person in DC, in that both sides of the political aisle dislike him historically. And so on the one hand, you can understand, why he would want to try and forge this relationship with President Trump. On the other hand, it's unclear if it's working. And I think that we have sort of, to this point, not seen the returns on those efforts from him. There's a bunch of stuff that Meta is still facing in terms of regulation and politics that are hard for the company. And I'm not sure that he's quite gotten the return that he wanted yet.
He bought a mansion in Washington, D.C., he being Mark Zuckerberg. What's that about?
Yeah, $23 million, nice. As we all do, buy I believe, like a fourth home. I think the idea there is that he's just going to simply be in DC a lot more, especially over these next 4 years. I think it's certainly a signal to not only the administration, but others on Capitol Hill that, hey, I'm going to be a regular presence here, and you're going to see me around. I want to be involved. It's a change of posture for him for the prior 4 years, or at least the prior 2 years. He had really sort of handed the policy and politics part of the business over to Nick Clegg, who was the former deputy prime minister of the UK. But Clegg announced that he's leaving shortly after the election. And I think Mark Zuckerberg has sort of picked up that baton, and he's sort of said, I need to be the person to do this. Donald Trump doesn't want to deal with a number 2 or a number 3 at any company, right? President Trump wants to deal with the CEO. And I think Mark Zuckerberg knows that, which is why he's showing up in DC himself as often as he is.
What you also talk about in the piece is just the contrast between Elon Musk and Mark Zuckerberg, like two entrepreneurs, incredibly brilliant, starting different companies, and just how politically their paths have diverged.
Yeah, we had this section in the story about how it was described as a sort of Elon envy on Mark Zuckerberg's part. So you can kind of imagine he's, for years, kind of getting grilled, as we talked about, by politicians on both sides. He spent a lot of time, at least a few years ago, apologizing, right? Hey, we need to do better. We're going to do better. Kind of like trying to appease everybody to no success. And meanwhile, you look out, if you're Mark Zuckerberg, and you see what Elon Musk is doing, and he's pretty much just doing whatever he wants, consequences be damned. And I think they're developed a sense of like, why am I out here apologizing? Why am I out here trying to please everybody and play down the middle and all this stuff when he's out there, he being Elon, picking a side, donating, hundreds of millions of dollars to the Trump campaign, literally campaigning for the president while running a social network. And there seems to be no repercussions. And so I think over time he developed, like I said, this like Elon envy, this sense that maybe I'm doing it wrong and he's doing it right. And I think we've seen some of that sort of show up in the way we see Mark Zuckerberg the last, 6 to 12 months. He's a lot less, he's an unapologetic guy as far as how he used to be. And I think Elon has a lot to do with that.
Our thanks to Kurt Wagner, Bloomberg News tech reporter.
Coming up on the program, we'll break down why the sporting goods retailer Dick's Sporting Goods is maintaining its annual sales and profit forecast.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This week, the department store chain Macy's posted better than expected quarterly sales and maintained its sales outlook for the current year. This comes despite new tariffs and moderation in consumer spending.
Meantime, the clothing retailer Abercrombie & Fitch raised its full-year outlook, showing confidence in its ability to navigate the changing tariff landscape.
For more on these companies, we were joined by Mary Ross Gilbert, Bloomberg Intelligence Senior Equity Analyst covering retail.
We first asked Mary for her key takeaways on Macy's most recent quarter.
I think the green shoots here is that Macy's is showing some traction here with their refresh strategy. When you look at their 125 stores that they've refreshed and they've expanded that to include some additional stores, their comp sales were down about 2%, about 1.9 is the figure that they're using. And, look, Dillard's outperformed because they were down 1%. So they're getting better, but where they really need to improve is on the service levels. Where you also saw strength here is really on the luxury side, and that's Bloomingdale's. Bloomingdale's was up 3.8%, and Bluemercury, which is their specialty beauty growth concept, and that was up 1.5%. So that's where you're really seeing strength, but it's such a small piece of the business. It's really all about the Macy's nameplate. And we still need to see better traction there, but it's getting better and better. And with regard to the tariff hits, it's going to be about 20 to 40 basis points, so very manageable. They directly source about, we estimate that their private label business is about 13 to 14%. That's on a consolidated basis of sales. And so they're sourcing about 27% from China directly. So they have a number of initiatives that are helping them to offset the full effect of tariffs, which you'll see the biggest hit in the second quarter. But for the full year, it's very manageable, in that 20 to 40 basis point impact.
Mary, for Macy's, are they comfortable with their store footprint these days?
So, Paul, they're reducing their store footprint with the Macy's nameplate. With some of the stores that they're closing, they've already closed 64. The total that they plan to close is 150. Wow. So they sort of feel like the go-forward store base is about 350 stores. But right now there's a little bit of a pause, just because of the real estate market and some of the store closures that they have planned for this year. But yes, no, they need to take that store base down.
All right, let's go to the other one, the highlight here, Abercrombie & Fitch. I'm kind of floored by this. Like, we saw it with Urban, we saw it with American Eagle. Like, these specialty stores, they seem to be somewhat cyclical in nature, and they're crushing it right now.
Yeah, I mean, you can say Abercrombie is crushing it. They kind of are, but I mean, if you look at the namesake brand, the Abercrombie & Fitch brand, that was actually down 10% on a comp sales basis. But in all fairness, they were going against a 29% increase in the prior year first quarter. In a way, you'd say, look, that's no excuse. And certainly they were impacted in the quarter by lower average unit retail. That was because they had some carryover inventory from the winter season. And also, it looks like they had a little bit of a miss on their bridal, the wedding business. But where they did have some strength was in swim. They really chased after it. So they've really got a good sort of summer shop going. And they expect that Abercrombie will inflect back to positive in the second half of the year. Where you really saw the strength was Hollister. So Hollister turned in a nice 23% comp sales gain, and that was on top of a double-digit gain last year. So they're really hitting it out of the ballpark, with the teen Gen Z retail customer there.
Hey, Mary, what are
Yes.
the Macy's and the Abercrombies of the world? What are they saying about the consumer right now?
Yeah, so Macy's is taking a very cautious perspective on the consumer. We think the consumer is pretty resilient. I mean, clearly at the higher end, they're more resilient than at the lower end, and there's some caution in there. But generally, I would say, when we have employment levels, in that sort of unemployment levels in that sort of 4% range, that's really full employment. And when you're employed, you feel good about spending money. So we really think it's holding up. We think retailers are taking a cautious, conservative approach, hoping to be able to beat, and we think they probably can, particularly as we get into the back half of the year and they're able to allay more of the tariff impact as well.
Our thanks to Mary Ross Gilbert, Bloomberg Intelligence Senior Equity Analyst covering retail.
We move next to news from the sporting goods retailer Dick's Sporting Goods.
This week, the company said it maintained its annual sales and profit forecast, and this can be viewed as a sign of strength as the retailer prepares to acquire the struggling footwear chain Foot Locker.
For more, we are joined by Lindsay Dutch, Bloomberg Intelligence Consumer Hardlines Senior Analyst.
We first asked Lindsay for her key takeaways from quarterly results at Dick's Sporting Goods.
Yes, so the numbers, Dick's did pre-announce when they announced their Foot Locker deal a couple weeks ago, and numbers were in line with their pre-announcement, but the key focus was that guidance, what they left where they set it at the beginning of the year, and it really tells us, combined with the strong first quarter results, that demand is holding very strong for this company, and we should continue to see growth in coming quarters, and tariffs with the rising costs there should be manageable for the rest of the year.
What changed? Because I feel like before earnings season, we thought this was going to be just like total disaster for retailers when it came to tariffs. Did something fundamentally change, or did we just not give them enough credit?
So I think Dick's might not be a barometer for retailers across the board. I think they're uniquely positioned in a couple of ways. One is that their consumer base is a higher income consumer. That consumer has been holding up pretty well, and we haven't seen a change, in the spending patterns for them yet. The other piece I would say is, Dick's has done a really great job improving their assortment. And because they carry, premium brands, they are in a very good position to pass through these higher costs to that consumer. And we expect that more affluent consumer to continue to spend on Nike, even if it's 5% higher in terms of the shoe that you're picking. So it is manageable, for Dick's, and that might not be the case across the board, but they are positioned to do so.
Lindsay, I'm just guessing that my sneakers were not stitched in Peoria, Illinois. So what are they saying about tariffs and the impact on their margins?
Right, so we haven't gotten a lot of specific details, but in the guidance, they are still expecting about 75 basis points of gross margin expansion this year. So that expectation of growing margin is still in place. Like I said, I think that they're looking to pass those higher costs on to consumers, so that's sort of a margin neutral impact. And the way they're getting the expansion on the margin line is, Dick's has really pulled back on promotions. They don't really offer blanket discounts. You never see 20% off the entire site, not even on Black Friday. They just don't do that anymore, and they haven't really done that since the pandemic. Once they saw that consumers really are interested in sports, fitness, athleisure, they will pay the full price, and they plan to continue to sell through on the full price for the rest of the year.
What other stocks in your coverage are holding up surprisingly well?
Yeah, so that's a great question, Alix. So we had Williams-Sonoma report last week, and they too held their guidance flat. Very similar backdrop for them. Again, it's a higher income consumer. They are seeing demand, for the price point of their goods, especially in the Williams-Sonoma home brand. That's performed very well. They're also making inroads with kids and their teen Pottery Barn brand. So that's another one, very similar to Dick's. Both kind of entered the year with strong demand momentum, and we saw that demand continue into the first quarter, and it looks like it could continue to extend this year.
Our thanks to Lindsay Dutch, Bloomberg Intelligence Consumer Hardlines Senior Analyst.
We move next to the auto sector. This week, the automaker Stellantis appointed its Americas head, Antonio Filosa, as its chief executive officer.
And this comes after former boss Carlos Tavares was forced out over slumping sales and profit.
For more, we were joined by Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Analyst. We first asked Steve to break down this week's news.
Well, the old CEO resigned.
Okay.
Part of it is because earnings were pretty bad, and it may not be 100% his fault. The auto market was weakening. So we have a new CEO. He does have a lot of experience in the auto industry. He's been with Stellantis since 1999. So it's been a while. Like you said, the last stint he was at was in managing the North American business for a few months. And prior to that, he was at Jeep. But, it took a number of months for them to identify someone new. But I think the market's just pretty surprised that they went with somebody internal and not somebody external.
So what do we learn about that? Because so many of the problems that are hitting car makers are in some ways completely out of their control.
Yes.
In terms of trade, supply chains, sort of the war on EVs here in the U.S., right? So do we learn that, we don't think it's very fixable, so we're not going to worry about someone from the outside? Or is it look, the U.S. is in turmoil, we need someone who knows that market? What do we learn?
So there's, they do have issues that's not in their control, but there's a lot of issues that they are in control. So, quality is an issue. I think a lot of American buyers thinks Jeep has kind of fallen off in the quality side. The new CEO, Antonio, actually managed Jeep for about 2 years. So, I think, investor will take that as probably a negative. And then the other issues is morale. Over the past few years, sales have been weakening. They've been closing a lot of plants as a result. Dealers are not very happy with some pricing issues since COVID. So there's a lot of issues that, the new CEO will have to kind of address, and hopefully he can turn that around.
All right, so for the big three U.S. automakers in general, what is the consensus on tariffs and how much it will impact their business?
Well, interestingly, Trump has been giving a lot of reprieves and reliefs to various countries and regions and certain sector, but he hasn't really done much for the auto industry. There was some relief, a 2-year relief, but I think he's going full ahead with these auto tariffs, and a lot of companies still don't know how big the impact is. GM actually announced they're going to be a $4 to $5 billion impact this year.
Wow.
Toyota said, over between May and March and April, the impact was 1.3 to 1.5 billion. So given these numbers, it's going to be huge.
What about EVs? Is it possible that EVs in the U.S. go the way that EVs went 100 years ago?
It could.
That's not immaterial anymore.
I think, there's a number of issues that's facing the EV market. Infrastructure is a big one. It's just not as convenient as people would like it to be. The other thing is the cost. I still think that EV has a place in the marketplace. It's not going to be 50% market share by 2030. We think it's more like half of that, 20 to 25%. And then look, there is a risk to a lower number because of the tariffs and affordability. Some of these EVs are actually made in Mexico. So if you slap on tariffs, that makes it less affordable for consumers.
Our thanks to Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Analyst.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube. and always on the Bloomberg Terminal.